Warren Buffett is sitting on almost $334 billion in liquid assets, and the media is losing its mind over it. Some say he's preparing for a market crash. Others think he's lost his edge. But here's what they're not telling you. If you've been following Buffett's strategy, you've likely been losing money or potentially been underperforming quite significantly. Let me explain why blindly following Warren Buffett could be one of the biggest mistakes you ever make. Let's start with the cash hoarding. Warren Buffett currently sits on around $168 billion in cash out of the $334 billion in liquid assets, making a significant increase over recent years. Why is he doing this? Well, based on his value investing approach, Buffett perceives current market valuations as high, leading to fewer attractive investment opportunities by his standards. But here's the thing. If you've taken this as gospel over the last 2 years and stayed out of the market, you've been watching a historic bull run pass you by. If you've been stockpiling cash like Warren Buffett, thinking you're playing it safe, you're actually making one of the costliest mistakes possible. The numbers don't lie. The S&P 500 has climbed around 70% since 2022's low, and individual stocks, well, they've climbed significantly higher. Nvidia has soared over 1,000%, Vistra Corporation has climbed around 500%, and GoDaddy is up 180%. And that's just naming a few. Now, be honest, how would you feel looking back at those missed opportunities? As an investor, likely very unhappy. A little side note here, Warren Buffett's Berkshire Hathaway has allocated a significant portion of its cash reserves into US Treasury bills, collecting around 5% a year. Sounds reasonable, right? But here's the catch. Numbers suggest that Buffett is earning around $16 billion annually in interest income from those US Treasury bills, apparently more than what he makes in stock dividends. So Warren Buffett actually is not just letting the cash sit. His cash pile is working for him. But unless you have billions to throw into Treasury bills, it's not working for you. If you're holding cash because Warren Buffett is hoarding cash, you might be collecting 5% interest, but let's be real, that's hundreds of dollars a year, not billions. It's not changing your financial future. Think about this. While you were earning 5% a year in cash, someone else turned $20,000 into nearly $4 million by riding market trends. Let's break this down in real numbers. If you invest $20,000 at 5% annually for 20 years, you'll end up with just over $53,000. If you invest the same $20,000 and average 30% a year as we do, you'll have almost $4 million. That's not just lost money. That's an entirely different financial future. And if you divide the roughly $53,000 into 25 years of retirement, that's loose change every year. Buffett's preference is to invest in undervalued stocks, buying companies when they're dropping in price and considered a bargain. But if you've ever tried this yourself, you've likely experienced a serious pitfall. When you buy into a stock that's dropping, it rarely shoots up right away. In fact, it often keeps dropping. There's a term for this, catching a falling knife. It's slow, it's frustrating. You're losing time and missing serious growth opportunities. And the difference between you and Buffett, while he holds, he's collecting billions in dividends. You, maybe a few $100 a year. That barely moves the needle. Yet there's no getting away from Buffett and his cash hoarding because it's everywhere. The media loves to push the narrative that Buffett is waiting for a market crash. But here's where it makes absolutely no sense. If he's predicting a crash, why is his own stock, Berkshire Hathaway, setting record highs? This is why blindly following Buffett's strategy can be dangerous for individual investors. So the real question is, what should you be doing instead? Here's what I do. I stay aligned with the S&P 500. It's my primary market indicator. When the S&P 500 is bullish, I buy the best performing stocks. When the market is correcting, first of all, I don't panic. Instead, I cut out of weak stocks and hold on to winners. So let's look at some recent examples. In this recent market correction, Palantir and Apple, stocks that get a lot of media attention, dropped 17% and 40% respectively, while the S&P 500 dropped only 10%. Those were weak stocks worth potentially cutting from your portfolio. However, Berkshire Hathaway and CBOE Global Markets have climbed during this correction, meaning they were strong stocks to hold onto, which we have done and are now looking to add more into the portfolio, as they are stocks leading the recovery. Instead of Buffett's undervalued approach, I use a trend following approach. I buy high and sell higher. I focus on stocks with a 5 to 10 year history of moving up. I look for stocks outperforming the market, not just following it. So while the S&P 500 has climbed 70% since 2022, the stocks I mentioned at the start of this video, Nvidia, Vistral Corporation, and GoDaddy, have climbed significantly higher. And those are the type of stocks I focus on. And that's why we average over 30% a year, while financial influencers tell you to settle for the market average of 8% a year. The difference after 20 years, 7 figures in wealth. But knowing what not to do is just the first step. The real question is, how do you actually build a portfolio that beats the market? Well, that's exactly what I cover in the next video, where I'll show you the exact weekly routine that makes us a consistent 30% a year. Once you see this in action, it'll all make sense.